Okay, well, let's continue on with some of the exercises from Chapter 9. Number 16, it reads, Willow Creek Company purchased and installed carpet in its new general offices on April 30th for a total cost of $18,000. The carpet is estimated to have a 15-year life, no residual value. Prepare the journal entry necessary for recording the purchase of the new carpet. Of course, we just debit carpet, credit, cash. Record the December 31st adjusting entry for the partial year depreciation expense for the carpet using straight line. Okay, well, we said it was $18,000, 15 years. It was bought April 30th, so that's essentially May 1st. So May through December is 8 months, so take it times 8 divided by 12. We record $800 for depreciation expense. Number 17, it reads, equipment acquired on January 8 at a cost of $212 had an estimated useful life of 15 years, residual value $14,000, and is depreciated by the straight line. What was the book value of the equipment on December 31st at the end of the 5th year? At the end of the 5th year. Well, let's look at this. The cost of the equipment was, again, $212. And it was a 5-year life straight line. Right? Correct? A 15-year life straight line. So $212 minus the salvage value divided by 15 is $13,200. So at the end of the 5th year would mean we have $13,200 times 5, or a total of $66,000. Our net book value is $146,000. Assuming that the equipment was sold on April 1st of the 6th year for $105,800, journalize the entries to record depreciation for the 3 months until the sale date and the sale of equipment. All right, so the very first thing you do is you calculate depreciation to date. Well, again, it's $13,200 a year. April 1st is essentially March 31st. So we depreciated it for 3 months over a course of a year. So $13,000 divided by 12 times 3 is a total of another $3,300 worth of accumulated depreciation. $13,200 is for the year. We divide it by 12. We get a month rate and take it times 3 for the first 3 months. That's $3,300. Now, this is the next thing that would probably be one of the most important things you hear in all these videos. How to record the sale, and it's always in this step. First, record the cash. How much cash do we get? $105,800 is what they told us in Part B. Then you record the removal of the asset. That's step 2. So step 1 is the cash. Step 2 is the removal of the asset. And the asset includes 2 things, the cost and accumulated depreciation. Well, the cost was $212. The accumulated depreciation is this $66,000 and the $3,300, right? We know what the 5 years is. We just added another $3,300. So right here, $69,300. If you do it in this step, then step 3 is the plug. It's always going to be your gain or loss. Well, in this case, to make the entry balance, we need to book a $36,900 loss. You do it in that order and not forget about both of those items, you will have no problems. Number 18, it's a disposal of a fixed asset. Equipment acquired on January 6 at a cost of $375,000 had an estimated useful life of 20 years and an estimated residual value of $25,000. What was the annual amount of depreciation for years 1 through 3 using the straight line method? Well, again, it had a $375,000 cost. $25,000 residual value divided by 20 is $17,500 each year. What was the book value on January 1 of the 4th year? Well, again, cost less that times 3 is $52,500. Our net book value is $322,500. Assuming that the equipment was sold on January 3 of the year 4 for $300,000, journalize. Well, step 1, record the cash. Even if you disposed of it into the junkyard and got nothing, your first entry would be 0, right? Of course, you wouldn't debit cash for 0, but you know that that's step 1, 0. Step 2, remove the cost and accumulate it. Cost, $375. The accumulated depreciation was $52.5. Then we see if our entry balances. It doesn't. It needs another debit. So we have a loss. And to make it work, it's $22.5. Letter D, it says now we got $325,000 instead. So again, $325. Remove the cost, the accumulated. Step 3, we need another credit. Well, in this case, it's a gain. In this case, it is a gain. And then number 20, amortization. That is the exact same thing as depreciation. The difference is depreciation relates to something that is tangible, like equipment. Amortization relates to things that we cannot touch, like a patent, a copyright. So number 20, Clean Company acquired patent rights on January 10 of year 1 for $2.8 million. The patent has a useful life equal to its legal life of 8 years. On January 7 of year 4, they successfully defended a patent in a lawsuit at a cost of $38,000. Determine the patent amortization expense for year 4, ending December 31st. All right, so what we have here is $2.8 million that was for 8 years. That's the first portion. And then there was another $38,000 that was incurred on year 4 of the first part of year 4. So we got all of year 4, 5, 6, 7, and 8. So there's another 5 years for this $38,000. It's still an 8-year life, but we incurred another $38,000 that should be amortized over the last 5 years. Well, that's a total of $357,600. What's interesting about amortization is you debit the expense just like you do with depreciation, debit amortization expense like you would depreciation expense, but you do not credit accumulated amortization, but rather you credit the asset directly. Why? Because after the end of 8 years, that patent protection is gone. There is nothing left. Unlike a car, when you get it fully depreciated, you might still have the car yet, and it might still be operational. So even though there's 0 book value, it is still an asset that is out there. The patent, on the other hand, is now gone. We'll stop there for now, and then we'll finish with a few problems.